Hello, everyone. Thank you for joining us for our webinar, The Art and Science of Business Valuation, presented by Professor Atulya Sarin. My name is Rachel Lake, and I will be my pleasure to moderate today's session. Before we get started, I have just a couple of housekeeping items for our audience. First, all attendees are currently in listen-only mode, which means we can't hear or see you, but we encourage you to participate in the GoToWebinar control panel. You can submit questions throughout the presentation beneath the corresponding tab, and then we'll do a formal Q&A session at the end. Second, we are recording today's session, and you'll receive a copy of the recording via email in the next day or two. So go ahead and keep an eye on your inbox. Now we have those details taken care of, I'd like to introduce today's panelist. Professor Atulya Sarin is the professor of finance in the Leavey School of Business at Santa Clara University. As a member of the SCU finance faculty, Dr. Sarin has taught numerous graduate and undergraduate courses and has received numerous academic honors and awards. Dr. Sarin has published Foundations of Multinational Financial Management, a textbook on international finance, as well as more than 25 scholarly articles. Dr. Atulya Sarin specializes in valuation issues. He has served as an expert witness and consulted on valuation issues on behalf of the IRS, Alabama Department of Revenue, California Franchise Tax Board, Massachusetts Department of Revenue, Minnesota Commissioner of Revenue, New York State Department of Taxation and Finance, Oklahoma Tax Commission, and the Securities and Exchange Commission, the Department of Justice, and the Canadian Department of Justice, as well as for numerous firms and banks. It's a pleasure to have you here, Professor Sarin, and I'm excited to get started. I'm going to go ahead and hand the presentation off to you.
Thank you, Rachel. So today what we will be talking about essentially is the art and science of valuation. There is, of course, a science to this, but as you will appreciate in a few minutes, that really there is a lot of art to it also. So specifically what we will be talking about is the two different methods of valuation, the DCF, or the discounted cash flow, or also what is referred to as the intrinsic valuation, and the relative valuation, or valuation by using comparables. So we typically will learn how to value companies using these two methods, and then figure out where in certain situations it might make sense to apply a control premium or a marketability discount, and then finally account for the non-operating assets to arrive at the value of equity. I want you to appreciate that valuation is at the heart of most financial decisions. If you think about investments, for example, the whole idea of whether we should invest or not depends upon whether something is undervalued relative to what is currently undervalued relative to what its true value is. When we are talking about corporate decisions on whether to invest, whether to acquire another company, again, it is a valuation issue. So valuation is fundamental to almost all financial decisions. So let's first talk about the DCF method, the intrinsic method. And this one, I really want you to appreciate that is really the right way to think about valuation. That the value of any company is the present value of all future free cash flows. So if there's an entity that essentially produces cash flows, what we do essentially is we go out and discount those cash flows to at an appropriate discount rate to reflect the riskiness of those cash flows, and whatever the present value of that is the true value of the company. And this is the most critical thing one needs to appreciate. Ignoring the fact that eventually what we are doing is we are really trying to value the free cash flows often leads to many valuation issues. For example, I mean, many of you may have read about how WeWork essentially was supposed to have a very large valuation, but its valuation fell drastically as they were in the process of having an IPO. And really what it was that the analyst appreciated or realized that there was no clear path to profitability in the current business model. So there were no future free cash flows that they could see. And so since they could not see the free cash flows, clearly that particular entity did not have much value. And that leads to the question, what exactly is a free cash flow? And in the context of WeWork, you will appreciate that. So the first part of your free cash flow really is how much cash the company generates from its ongoing business. So which really is, I mean, what its revenues are, less what its costs are, less what taxes it pays. It is oftentimes referred to as NOPAT, or net operating profit after tax. But that's just one piece of it. And that's what typically a lot of times companies focus on. But reality is, for a company to grow or to sustain its existing operations, it also needs to keep on making investments. And that was WeWork's issue, essentially. They have to keep on making a lot of investments. The investments might come in terms of either capital expenditures that might be required, or the working capital requirements that the company needs as the company essentially tries to grow and sustain its operations. So the difference between the two, the net operating profit after taxes and the cash investments, that is your free cash flow. And really that is what we are trying to value. So what we are doing is, in principle, what we do is we go out and project the free cash flows over a long period, over a period of time over which you expect this entity to maintain, to be around, which in terms of equity is for most companies is perpetuity. And then we effectively go out and discount that back using the appropriate discount, appropriate rate to account for the riskiness of those cash flows. So in principle, it is very straightforward. To value a company, go out and project the cash flows and discount it back. But of course, implementing it is somewhat much harder, because what we are trying to do is we are trying to go and make a sense of how and how much the company is going, free cash flows the company will be able to generate into the future. And unless you have a direct line with God, it really is very hard to go out and see what the future cash flows will be. And even the riskiness of those cash flows is just an estimate, because at the end of the day, we do not know. In some cases, companies well surpass what their expectations are. In some cases, companies actually go out and are never able to deliver on whatever they were promising. So even though in principle it's a simple thing, as we'll talk about a little bit, it is a hard thing to go out and do. So let's first talk about projecting the cash flows. As I pointed out, the two parts of projecting the cash flows really is the first figuring out what its operating profits are, or let's call it the cash earnings, which essentially means you have to go out and project the revenues, the cost of goods sold, your SG&A expenses, and also what your taxes are going to be. And the second piece is to go out and project what its investment requirements are, be it in terms of capital expenditures or acquisitions that company might be required to make, or the changes in the net working capital. Appreciate one thing, and this is something, the most important thing to appreciate. These free cash flows are tremendously dependent upon what the expectations of growth are. Growth makes all the difference. And that is why you must have noticed that high growth companies like Google, companies like Facebook, they effectively have very large valuations, because growth is the most critical assumption when we are trying to value a company. In this very stylized example, let's say there is a company which essentially goes out and is able to generate $1 in revenue, and for sake of argument, let's say the discount rate, or the rate which we will use to discount the cash flows to reflect the riskiness, is 15%. If the growth rate is 14%, that same company is valued around $100. However, the growth drops from 14% to 10%. So a 4% drop in growth will actually reduce the value from 100 to 20. So 80% of the value will be lost if you effectively go out and reduce the growth from 14% to 10%. And consequently, actually, if you just go from 14% to 13%, or a 1% change in growth will reduce the value from 100 to 50. So that is why all along, effectively, when people talk about how what happens, sort of like right now, for example, the economy is not growing at a tremendous rate, maybe 2-3%. But on the other hand, if you change that assumption and say the economy is going to grow to 1%, you will see that there will be a large decline in the stock price, or worst case, if they fall into recession, which really is, again, if you think about it from a growth perspective, all we're doing is going from 2-3% to a negative 0.5 or negative 1%, you find that the stock market could easily land up losing a very large part of its capitalization. And so how do we estimate growth? At some level, you can do one of two things. If there is a company which essentially has a historical has a history, and we know that the history of growth is somewhat stable, in that case, what we could just land up doing really is we could just be averaging what its historical growth rate is and use that in our assumption about how the company will grow. For many companies, especially tech companies, which sort of are around here, they don't have a lot of history, and the growth is very, very volatile. And in any case, I mean, history is not really a perfect indicator, or even a good indicator in many cases, about how the company will continue to grow. In that case, one needs to sort of evaluate whether through a variety of different factors to see what its growth is going to be. But this, as I point out, is something which sort of, as you're trying to value anything, you need to be very careful about and pay a lot of attention to, because this particular assumption can have a large impact on what its true value is going to be. And then clearly sort of, trying to go out and project growth beyond a certain point in time makes no sense whatsoever. So what you effectively land up having to do is you need to effectively make an assumption about what its growth is going to be in a perpetual sense, because companies are expected to continue forever. And for that, oftentimes what we do is we tend to try to say, well, in the long run, so there are two parts to it. The first thing we need to figure out, how long will this supernormal growth continue? And studies have shown, and most people will create a 5-year model to show that the high growth will continue for 5 years. And after that, what you do is you effectively go out and estimate terminal growth. And oftentimes what we'll end up doing really is we'll end up using the growth in the economy as a measure of what the terminal growth is going to be. And because there is it's mathematically true that in the long run, no company can grow faster than the growth rate in the economy, because if it did, as a matter of mathematics, what will happen is that company will be the only company in the economy. On the other hand, it can grow less than the growth in the economy, and if it does, it will continue no longer to exist, because it will become smaller and smaller part of the economy. So what we'll end up doing is, for the long-term growth rate, we tend to use a growth rate in the economy, and there are a lot of places from where we can get that information. The second thing is to figure out what their margins are. And then that's, again, a very big driver of what the value of a company is. Clearly, which company, which essentially can land up having very high operating margins. Like, we think about companies like Facebook, for example, or Google. I mean, their search piece of it has incredibly high high margins. That company is going to be a lot more valuable than a company which essentially is like, let's say, a retail grocery store, for example, which has very low margins. So we have to be careful on how to go out and estimate the operating margins. And to do that, what we do is we effectively typically go out and try to see what the historical information is available to see whether it has a steady operating margin which we can use, or sometimes we blend it with industry margins, because eventually the idea is that most companies can't have margins different than what are there in the what are the industrial margins in that industry, because again, the factors which drive a company's margin eventually are the same all companies face on it. So the industry margins are really a good proxy oftentimes in the long run for what the company's margins are going to be. The next thing we have to do is estimate the taxes. Now, of course, we have a marginal tax rate. I mean, it was which we can use, but reality is we tend not to use the marginal tax rate, because many companies have different tax plans which they have in place, tax planning strategies. So the tax structure can be quite different for different companies. Oftentimes, you would try to go and try to identify what their particular average tax rate is, and many times you would go out and try to talk to the company's CFO or get information about, based on their forecast as to what exactly they believe that the tax rate they expect to pay. So these three pieces lead to the cash earnings, and then the next thing essentially is the investments piece. The investment piece, as I said, has two components to it. One is oftentimes the net capital expenditure. For companies to grow, they need to continuously keep on making investments in physical assets. If you look at it, there is a lot of evidence which shows that your sales to fixed asset ratios continues to be the same, irrespective of over time. So what you tend to do is you can look at companies' historical sales to asset ratios and go out and make enough capital expenditures to make sure that as their sales are growing, they effectively also their capital expenditures are growing in line with it. And that because you really cannot have a situation whereby you can grow the company without making any investments. The next piece is your net working capital. What I mean by net working capital is for any company to operate, what they need to do is they will have some accounts receivable, they will have to have some inventories, they'll have to have some accounts payable. So as you effectively grow a company, all these things will essentially increase. But some of them, like your receivables and your inventories, are essentially a drain on your cash flow. So you will need cash to be able to offset, to be able to fund your receivables and inventory, but also your payables may be going up, which may well be a source of cash flows. And the difference of all these three essentially is your net working capital. And we need to make sure, we need to go out and estimate what your net working capital is going to be. And again, sort of oftentimes for stable companies that is more or less constant. Sometimes you blend it with industry to make sure that we don't have any particular outliers in the history of the company. Again, understand that the reason why we are looking at the company's history and using that to project the free cash flows is because that's the best we have. But reality is, in the historical numbers, there could well be many recurring or and kind of one-time kind of events. So, for example, you may have a situation whereby the company may have had a large litigation settlement in 1 year, and you do not want to go out and try to account for that. You need to account for that when you're using the cash flows from that year as a basis for going out and trying to project what the future will look like. So we need to affect, and also there could be variations over time. So what we want oftentimes to end up trying to do is, when we're looking at the margins or some of the other expense items, we effectively go out and try to normalize it and try to see so that we can have an idea of what a base year, a steady base year will look like, which we can use as the basis for going out and making the projections in the future. So that's sort of, once we have projections about the cash flows, the next thing essentially is to figure out what the appropriate rate would be at which we go out and discount those cash flows. And typically what we use essentially to discount the cash flows is what is referred to as WACC, or weighted average cost of capital. What we are trying to do is we are trying to account for the different sources of capital and the company's capital structure to arrive at what their average cost of money is. And then, like I said, there are three components to it. There is a cost of equity, there is a cost of debt, as well as the capital structure. All three combined affect what the average cost of capital is for that particular company, and we use that as a measure of the rate at which we go out and discount the future cash flows. And so first, let's talk about the cost of equity. The cost of any security has two components. There is a risk-free rate and there is a risk premium to it. The risk-free rate, in a very simple terms, essentially accounts for the fact that anybody who's supplying capital is deferring the use of their capital, and because of that, they need to be compensated at whatever is the risk-free cost of capital. The other piece really, which is and that, by the way, can be easily observed, because what we typically do is we use government securities to figure out the risk-free rate. The second piece, which really is the risk premium, depends upon the riskiness of the security that we are trying to value. In case of equity, for example, the risk premium is estimated using what is called the capital asset pricing model, and then there are two components to it. One essentially is the beta, and the other is the market risk premium. Let me talk a little bit about both of them. First of all, the market risk premium. The market risk premium is really the return that you would like to earn, the investors expect to earn over and above what they can earn in a risk-free security. And so if I invest in the market, naturally I'm taking on the risk of the market, and I expect to earn more than what I can earn if I were to invest in a total risk-free security. And the difference between the two essentially is the market risk premium. And how do we estimate it? There are two ways. One, of course, we can go out and ask and survey people and say, well, how much do you expect to earn in the market over and above what you can earn in the risk-free rate? And there is survey data available for that. The other one, which we can affect, which is a little bit more empirical in nature, but has its own biases, is the fact that what we can see is we can go back and look historically how much has the market earned over and above the risk-free rate. We have a good series from 1926 through 2018. 26 is when we have good data on stock in the stock market, and what we find really is that on an average the market has earned over 7.07% over that time period. And one thing is we can go out and use the market risk premium as whatever is the historical average, with the assumption that this is what has happened historically, and this is what we can expect to continue to happen in the future. In addition to that, when you're trying to value international firms, we may land up actually going out and trying to have an additional premium because investments in certain countries may be more risky. So you may demand a higher premium to account for the fact that you are taking on the riskiness associated with investing in that particular country. And the other is a small company premium. In a small company premium, it's just an empirical fact that smaller companies tend to effectively, on an average, earn a higher return. And then that makes sense, because if investors are investing in these smaller companies, there's a lot of uncertainty about the prospects of those companies, and also, so they effectively essentially require a higher premium to account for the riskiness of those of investing in those companies. And this is the evidence, as you can see, sort of, if you are a company which is in the lowest decile of the market cap, under $300 million, 299 to be exact, you effectively require a higher premium, around 5.37%. And then this is all graded, and this information is available from a variety of sources. So what we do is we effectively go out, and so that's how we get to the market risk premium. The next thing is about beta. What beta is a measure of how the company stock or equity moves relative to the move in the market. That's what beta is. And there are a couple of different ways to measure beta. One is, of course, you can do a regression analysis, whereby you can go and see historically what the relationship of the company has been relative to the market, and then that, using a regression analysis, and that relationship, that is a measure of what the beta is. The other, of course, really is in situations when you're trying to value a private company where we don't have historical data. What we can land up doing really is we can go out and see how we can go out and find the beta of the comparable companies, and try to essentially go out and use that to go out and proxy for the beta of the company that we are trying to value. I think I'm going to skip this bottoms up approach, and so let's talk about the second piece, which is the cost of debt. So in the cost of debt, what we're doing is we are trying to figure out how it has, again, the same two components. It has a risk-free rate, and the risk-free rate will depend upon the maturity of the debt, and the second is your premium. And to figure out the cost of debt, if we have publicly traded debt, it is straightforward. What we can do is we can observe what the yield to maturity is and use that as a measure of debt. If there are multiple debt instruments, we can just do some kind of a weighted average to arrive at what the average cost of debt is. But in situations whereby we don't have publicly traded debt, what we have to do essentially is we have to go out and try to figure out what the implied credit rating for that particular company is. And based on how comparable it is to other companies which have similar financial metrics like debt to asset ratios or interest coverage ratios. And then once we have arrived at what their average credit rating is, what we can do is we can figure out what the average yield is for a company which have similar credit ratings, and that is going to be your cost of debt. And of course, once we figure out the cost of debt, since oftentimes that is not oftentimes, it is always tax deductible, you need to make sure that you're looking for the after-tax cost of debt. So once we have the cost of debt, we have the cost of equity. The next thing which we do is we figure out what the company's capital structure is, meaning what's the ratio between its debt and equity. And in situations whereby you can all observe it right away, you go out and just observe it or look at what the company's target debt to asset ratios are. But in situations when we are trying to value private companies, we may have to find a set of comparables and look at what the average cost of debt is, average weight between the debt and equity is going to be. And once we have the capital structure, the cost of equity, and the cost of debt, from there on it's straightforward. All we do is we go out and figure out the weight of debt times cost of equity, and weight of equity times cost of equity, weight of debt times cost of debt plus weight of equity times cost of equity, and that gives you your weighted average cost of capital, which is the weighted average cost of capital is essentially to account for the fact that that is the appropriate discount rate to reflect the riskiness of the cash flows that we are trying to value. Okay, so that was what I wanted to say about the DCF, or the intrinsic value, which I think is the most appropriate way to value it. Again, to summarize, what we do is we go out and project the free cash flows and we discount them back with the appropriate discount rate to reflect the riskiness of the cash flows. The other method, which I want to talk briefly about, is the relative valuation. In the relative valuation, what we are trying to do really is we are trying to figure out what the value of a comparable asset is. It has a very strong intuitive appeal. If you're trying to sell your house, for example, and you don't know what the value is, but you know your neighbor's house, which is quite identical to yours, sold recently for X dollars, chances are you effectively, your house is valued also very similarly to the X dollars. And of course, if your house is bigger or smaller, maybe you might want to reference it in terms of what the cost is per square foot, and again apply to it to your square footage of your house which you're trying to value, and of course accounting for any differences, which maybe you may have an updated bathroom or a kitchen or what have you. So the same principle here, you find a similar asset and you go out and figure out what the appropriate valuation metric is going to be, and then you apply it to your company's metric, and that gives you the value of your business which you're trying to value, and you account for any differences, and the differences could be in terms of the growth opportunities or management considerations or anything else, or your margins might be different, and once you account for those differences, that gives you the value of the company you're trying to value. So again, so the hardest part in this whole process is in identifying the comparables. I've done this many times, and oftentimes, if this ever is debated, people, both sides, one which might be arguing for a higher valuation or the other which could be arguing for a lower valuation, may have a very different idea about what your comparable is. And so you need to be careful in trying to select the appropriate comparables. And what you oftentimes do is you want to make sure you have a methodology in place to identify the comparables. You create a large list and you effectively narrow it down using appropriate and defensible arguments so that you have the best possible set of comparables. Once you have the set of comparables, and you carefully document it so that everybody can observe exactly how you arrived at those comparables. Once you have the comparables, the next thing essentially is trying to figure out what the appropriate valuation multiples must be. And in concept, it is clear, like, going back to the price per square foot. I mean, you know what the price is, you know what the square foot is. In this case, it could be, you know what the value is, and you know what the, say you're doing a revenue multiple, you know what the value is, what the sales is, and you take the ratio of the two and multiply it by the sales of a particular company. Now, of course, in applying it, it has some issues, because you could argue that when it's a new company, for example, you may not have enough of a history, and the sales prospects might be in the future whereby you can't really readily observe, and people cannot really necessarily agree on it. So there are these things which we need to kind of appreciate, and these problems are different in different situations. For example, when you're doing revenue multiples, you effectively, it's easier, but because revenues are always positive. But when you're doing earnings multiples, you might realize some companies have negative earnings, and so the multiples might make no sense whatsoever. Or when you're doing book value multiples, you may realize that for young companies or companies which are in certain kinds of industries, the value of their fixed assets or their book value is not a very good reflection of what it is. And people have been creative. You see this with the new set of unicorns, and I am old enough to have observed it when we did the .com period. People come up with all kinds of interesting multiples, like the value or the number of website hits, or the number of subscribers, and so on and so forth. So, and like I said, each one of them has its own issues, and but there are some things which you always should sort of keep in mind. One is that you effectively always use a common metric, whereby the numerator and the denominator must be the same. So if you're looking at when you're looking at the P ratio, the price is of equity and the earnings are of equity. But if you're doing a sales multiple and the numerator is the enterprise value, then we effectively want to make sure that the denominator is also is coming for the entire enterprise. The second thing is you want to make sure that there is no averaging bias. If you take an average and some multiples are negative, and let's say when you're doing an earnings multiple, that averaging it into it may make no sense whatsoever. So you might prefer to do a median or something of that sort. And then in some situations you might do a normalization, whereby you might look at average for the last few years, both for your own company as well as for your comparables. And in some cases, when you're, let's say, trying to value a transaction, when you're trying to figure out what the value of a particular acquisition target is, you might tend to want to use a transaction multiple, whereby you look at other transactions rather than looking at just other companies which effectively are also traded in the market. Because for an acquisition, there could well be other things like synergistic values or some control premiums which might be embedded. So you want to make sure that they are accounted for. And then once we have got these multiples, like in this case, for example, we are looking at these different companies as the revenue, and we figure out the revenue multiples and the EBITDA multiples, and we go out and try to apply it for our company, and those multiples, and that will give us the value of our company which we are trying to value. It's probably better to use more than one multiple if possible, because all these multiples have this inherent problem, which really is that if your comparables are overvalued or undervalued, then you might end up essentially having a value by reference which may be too high or too low. So that's as far as the relative valuation is concerned. And the next is you may make sure that you're applying for any adjustments, like if the growth pattern is different, or the size is different, or your margins are different. You may account for the fact that these comparables have different growth drivers or value drivers, and you account for the fact that you might want to adjust your multiples to account for any differences in this value drivers. And like in this case, in this example, I show that I'm effectively taking the comparable multiple for the using my comparables, but I'm making an adjustment of negative 15% to account for the fact that the company which I'm trying to value is smaller and has lower growth prospects. And okay, so the next thing I want to talk about really is actually I'm going to skip this part in the interest of time, is the fact that some companies, when you're trying to value private companies, they are not marketable. So clearly, when I invest in a private company, I will probably I will effectively discount its value for the fact that I can't readily change my investment to cash. And for example, if I own shares of IBM, I can just go into my Schwab account and quickly convert it back into cash. But if I have an investment in a private company, I can't do that. So therefore, there is a discount which is appropriate for when the company essentially is not being traded in the public market. And also, in addition to that, and then there is a lot of evidence on what the appropriate marketability discount should be based on the level of illiquidity that company particularly has. If you want, I mean, there are a couple of papers on my website where we have estimated that. Also, in addition to that, there is a control premium. When you go out and value a share in 100 shares, which I own in Facebook, I effectively don't have control. And so when you're valuing by reference or using public data to value a particular company, you effectively are valuing a minority interest in the company. But when, let's say, you're trying to value 70% of a company, or you're just trying to acquire an entire company, in that case, you are going to be able to control the company, and that control has value. So when we're trying to value a controlling interest using data from the public markets, where we have data only on a minority interest basis, then we need to account for the fact that there will be a control premium. Again, how much control premium to apply is a question which practitioners struggle with. There are a few papers I've written on that, and they're available on our website. At this point, I think I was allowed 40 minutes, and I'm done with that. So I would like to hand it back to Rachel, essentially, and the team.
Sure. Thank you so much, Professor Sarin. This was really informative and just such valuable information. So I'm going to go ahead and give everyone a few minutes to finish getting their questions in. And then in the meantime, I'd like to introduce Toby McChesney, who is the Senior Assistant Dean of Graduate Business Programs at the Leavey School of Business at Santa Clara University. Toby McChesney has been the Senior Assistant Dean of Graduate Programs for Santa Clara University's Leavey School of Business since October 2016. He oversees admissions, student services, and career management for 3 MBA programs and 4 Master of Science programs. Thank you for joining us, Toby.
Thank you, and good afternoon, or almost good evening if you're on the West or East Coast. It's a pleasure to join us, and let's give Dr. Sarin a round of applause for a great job. Thank you, my friend. So he's talented, and that's a normal thing we see here at Santa Clara University is our fantastic faculty. So what you see in front of you is the map of the Bay Area. And as Rachel mentioned, I've only been here for about 3 years, moved from the East Coast, and didn't really understand this Silicon Valley kind of secret, but living here and breathing the air and seeing all the great tech companies, I fully see the powerful brand of Santa Clara and how we really infuse Silicon Valley into our coursework, both at the undergrad and of course the graduate level. So it's always important for us to show you all. So you can see Santa Clara at the bottom of the screen. We're in South Bay, so we're actually in San Jose. But as you can see, we're surrounded by a lot of the great companies that hire our students, but more importantly, our students come from as well. So we're very blessed to have our location be so stunning. And if you are in the cold right now, it is currently 70 degrees and sunny and beautiful. So not to make you too jealous, I hope. So Santa Clara University is a Jesuit university. We are one of 28 Jesuit universities across the US. We were founded in 1851. We actually the first university founded in the state of California. Many people really don't understand that. And we also are AACSB accredited. So when you look at graduate programs, it's important to have that accreditation behind the name. Our current dean, Karen Beck-Dudley, is a former board member and chair of AACSB. So we really understand the curriculum and accreditation process overall. And then our great alums. So as you can see there, we have over 100,000 alums from the university as a whole. From the graduate business programs, we're just about 20,000 of our students are from the MBA and Master of Science programs. So we keep in touch with them a lot. They hire our students and they come back to campus quite often. So that's a little bit about our location. And then our fantastic programs. So we have, as Rachel mentioned, 3 MBA programs. So our largest and most established MBA program is our evening MBA program. We have 350 evening MBA students. They are about 8 years of work experience, which is a little bit higher than the national norm. And we're very excited to announce that we were ranked 22nd by US News and World Report out of 301 part-time MBA programs. So we are definitely large and in charge when it comes to the evening MBA program. The second program is our executive MBA program that caters to people with more 10+ years of work experience. Our average actually is 18 years. Again, that's 4 years ahead or above the industry norm for the executive MBA program, ranked 13th by US News and World Report. And then just 2 days ago, we were ranked by Princeton Review for our online MBA program. So our evening MBA program was so successful that our faculty, Professor Soren is one of them, that said we need to have an online program, and we launched our online MBA program just 2 years ago. We have not even graduated our first class. They graduate in December. So to be a top 25 ranked program by Princeton Review is really phenomenal out of 110 online programs that were considered. And then the other side of the house are our Master of Science programs. You can see a common theme. We are very much STEM focused and really kind of, as I mentioned again, bringing in Silicon Valley and data science and numbers to our students. So our oldest Master of Science program is our MS in Information Systems, followed by our MS in Finance and Analytics and our MS in Business Analytics. All 3 programs are face-to-face. They take about 1.5 years if you want to go full-time. You can also go part-time as well. And all 3 programs, if you're signing in from internationally or whatnot, are STEM approved, which really helps your CPT and OPT down the road. So we're very happy with those 3 programs. And then the success of our MS programs coupled with our success of our online MBA program, we launched just this fall our online Master of Science in Marketing. So we now have current students living in 5 different states outside of California for both our online MBA program and our online MS marketing program. So if you are dialing in from DC or Florida, definitely consider the online programs. If you're living in the Bay Area or looking to move to the Bay Area, then I encourage you to look at either our on-campus programs or of course our online programs. I always enjoy seeing our students. We have a total of 749 graduate students. My biggest joy is welcoming you at orientation, but I'm even more excited to see your journey, see your progress. We have a great career team that works with you on your resumes and getting you new jobs, pivot your career. But really my excitement as a dean is to see our students graduate and do so well. So I look forward to seeing you all on campus or online. If you have any questions, you can feel free to email us at grabbusiness@scu.edu. And I'm going to turn it over now back to Professor Soren because you're going to ask him some tough questions. Thank you. I hope to see you soon. And go Broncos.
Thank you, Toby. That was great. Okay, so I'm going to go ahead and read out some of the questions that the audience have submitted. The first one is, in your FCF model, should we add the company's net financial assets to its cash flows? Net financial assets are marketable securities plus cash and cash equivalents, minus any short or long-term debt.
No, we should not. See, when you're, there are two assets the company has. One is its operating assets. In the DCF model, what we are trying to do is we are trying to figure out what the value of the operating assets are. And then when we try to look at the total value of the company, to that we go out and add any non-operating assets they may have. So you don't do it at that stage when you're trying to value its operating assets, but when we're looking at the total value of the company, you go out and actually go out and add those non-operating assets.
Okay, thank you so much. The next question comes from Satnam, and they would like to know, is there a way to ascertain operating margins for a given industry? And where can one look to find that information? For example, healthcare software company, hardware silicone company, toy maker.
Yeah, absolutely. So each company belongs to an industry. There's a 4-digit code called the SIC code, the Standard Industry Classification Code. So if you have access to a database, like, for example, at our school, we have access to a database called CompuStat, whereby what we can do is we can go out and pull out all the operating margins for all the companies which are in that particular SIC code. Say like a toy maker SIC code is 5412. So we can pull out all the companies which have the operating margins for that particular company, and we can just average it. If you don't have access to that database, these databases are incredibly expensive, and we are very fortunate that at Santa Clara we have access to a wide variety of databases, and it's great training to go through them. In that case, there is a website called, there's a fellow by the name of Aswad Damodaran. He's a professor at NYU. He has a website called Damodaran Online. What he does essentially is he essentially does list that the average numbers for each industry. So I would encourage Ratnam to go there if that's what he's looking for.
Okay, perfect. Thank you so much. This next question comes from Edward, and they would like you to please comment on the stock market valuation / share prices correlation to fundamentals. So financial quantification versus perceptual or speculative value.
I would rather not. If I was smart enough to be able to do that, I believe you me, I would be doing something else.
Okay. So
I mean,
I'll go to the next.
all I can say essentially is, I mean, I can give you factual things about it. The market is at all-time high multiples. The market essentially is probably accounting for the fact that it doesn't look like we are headed into a recession. We effectively have, at least in the near future, 6 months back, everybody was anticipating that in 2020 we'll be into a recession, but it doesn't look like, based on all the economic reports. The market is probably expecting some kind of a trade deal with China, and but the market is not cheap right now. The market is fairly pricey. But having said that, and then there is a technical side of it. A lot of people say that the technical people argue that in situations whereby the market has done so well in the first 10 months, like over 20% in this year, in that case, the last 2 months tend to do very well also. An average number is around 3.5% or so. So I am just as keen as everybody else that my 401k will go up and the market will do very well. But I think unless you have a crystal ball, or I said, as a direct line with God, it's hard to tell.
Okay, thank you for that. The next question comes from Satnam, and they would like to know what needs to happen to cause a loss in investor confidence and move to a cash position. causing a quick market correction?
I mean, a variety of things can cause that. I mean, think about, there's a lot of political turmoil right now going around. A lot of people argue that a conservative party like Republican essentially is probably better for the stock market than having a presidential candidate like Elizabeth Warren, who is sort of not very pro-business. So the impeachment hearings, whereby it looks like the President Trump might get indicted, or effectively might affect his chances of getting elected again, that might be bad for the market. The Chinese essentially are clearly kind of, the China is a big part of the whole problem right now. And with what all is going on in Hong Kong, and yesterday I think the Congress essentially approved sort of our issues which we have with Hong Kong essentially, and if that thing gets ignited further and the Chinese become less amenable to effectively do a trade deal, that could essentially create a problem. There are a lot of other political hotspots in the world which could essentially quickly erupt and effectively lead to a decline in the investor confidence, which could lead to a decline in sort of companies, or it could lead to a decline in companies being willing to make expenditures and invest. And if that happens, that could easily cause the market to go south. But on the other hand, a lot of these things could get resolved, and consequently the market could go up also. There's a risk in the market, and that is why what I was explaining earlier on, when we are looking at the market risk premium, there's a reason why on an average investing in the market has earned around 7% higher return than investing in risk-free securities, because this concept of risk and reward is at the heart of most situations, and higher risk leads to higher rewards on an average. But risk means that in the short run or in some time periods, you could actually land up losing money. That's what the definition of risk is.
Yeah, well, let's hope for the best.
Fingers crossed. Me too. Yeah.
Okay, so
and by the way, for whatever it is worth, the Silicon Valley essentially here is driving a large part of our productivity gain. And I am kind of very fortunate, having lived in the Valley for the last 25 years, and then seen essentially what being here and working here and studying here essentially it does. I mean, you go to a classroom here, I mean, there are people sitting out here next to you who effectively are at the forefront of technological innovation. And then that's what driving, and the big part of, if you look at the upside, where will the upside come from? A big part of the upside is going to come from these kids who will go to school here and other schools around in the Valley effectively, who are going to do incredible, wonderful things.
For sure. Okay, thank you so much for that. Andy would like to know what method of relative valuation to use for companies that are pre-revenue and they don't have many assets on the books yet.
That's always a challenge, and I think it all depends upon. I mean, I'll tell you what I have done when I've had to value the situations. So you may have be able to have a projection about what the revenues are going to be. You may have projection about what their margins or their earnings are going to be. You may have go out and effectively, I've done situations like that. I expect that my particular company 2 years down the road would be able to have an IPO, because that's sort of what my target, and that's where the trend essentially is. So I can go out and identify other companies who effectively were in similar situations 2 years prior to their IPO and see what value they came out when they had an IPO. So it's sort of not a one shoe fits all kind of a strategy, because you can't do that. But it all depends upon, can you find other situations which were comparable and see, and then hopefully a few of them, and be able to go out and see what happened to them and use that as a reference. Like I said, I have seen people do number of hits, the number of customers, number of subscribers. You can do all of that, and as long as you apply them somewhat reasonably, and then you can get an assessment of what the value of the company is.
Great, thank you. So I think if it's okay with you, we have just one more question.
Absolutely. Mm-hmm.
Okay, wonderful. So this is kind of a mix from a few different people. They're asking about pharmaceuticals and biotech. Do you have any recommendations for how to assess the valuation of these products before they've received regulatory approval or they've gone through clinical trials?
I've actually done a lot of work in the pharmaceutical industry. In my experience, sort of, and I do not know what stage these companies are in or what the products are in. Are they at phase 1, phase 2, phase 3? If they are at a later phase, so let's say they're in phase 3, in that case, companies typically will have a plan. If you're working with them internally, they will have a plan about how they have a sense about how large the market is, what fraction of the market they'll be able to capture. So you can actually go out and make a reasonable cash flow projection for those companies, or as reasonable as you can get. And then what you effectively do is you account, the riskiness of those cash flows are very high, because clearly, as we know, just because they're in a later phase does not necessarily mean they're always going to get an approval. And even if they were to get an approval, they need to still effectively go out and be able to generate, capture the market or have enough of a market share to be able to have large returns. So what you do is you go out with an assessment of, you go out from what the company's plan essentially is about what the plan they have for that drug, and then you go back and discount it fairly heavily to account for the fact that there is a level of risk involved in the other approvals coming and the drug being a success. And it's again, like, this is where I want to end up here, and I appreciate the opportunity. That I want to end up essentially is that the technique is, there is a science to it, and the science essentially is straightforward, which really is you go out and project what the cash flows are. You need to account for where all you can go wrong in those projections, and then you discount it back to account for the fact, the riskiness of those cash flows. That's the science piece of it. But when you are actually implementing it, you need to get somewhat creative, and that's where the art of it is. So all you're trying to do is trying to kind of be reasonable. Like with this drug example, I mean, you have a drug, you have a plan. You have a plan about how large the market is. You have a plan about how you're going to be able to sell. You have a plan about sort of how much money revenue you'll be able to generate, and that's all reasonable. So you go out and try to create a reasonable plan, and then you go out and try to account for the fact that there is a level of riskiness, and there is no right one answer essentially, and you account for the level of riskiness based on what the appropriate assessment is. And that is why effectively you have large divergences in opinion about what the true value is. There is a reason why there are so many people working in the stock market, and the stock market going up and down every day, because these opinions change. And so the long and the short of it is, there is no one way to do it. You just have to try to think about what would be a reasonable way to do it. And each situation is somewhat unique. And I really appreciate the opportunity to be here and talk to all of you guys. And of course, if you ever have any questions about it or want to talk more about it, my number is here, and feel free to send me an email. Thank you so much, Rachel.
Yeah, thank you so much, Professor Sarin. This was really interesting and so informative. I appreciate you taking the time to speak with us today. Before we draw things to a close, do you have any comments that you'd like to end on?
The whole idea really is, like I said, I mean, I'm being repetitive here at this point in time, is that earlier on, somebody asked this question about a pre-revenue company. And right now you're talking about sort of an uncertain outcome of a drug. These are just one of a few of many, many examples that most valuation professionals deal with on a regular basis. So the key really is that, in my experience, the key to coming up with the robust valuation is is essentially trying to figure out either a cash flow model or a comparable model which you can go out and defend. You'll be able to convince somebody that what you have done is reasonable. And I think that is how you effectively come up with what a robust value is. Thanks, Rachel.
Thank you. Excellent. Thank you, Professor Sarin, and thank you to everyone who watched the presentation and submitted questions. Just as a reminder, we're going to send out an email with a link to a recording of today's webinar, so you'll have access to that information. Thank you. I hope you all enjoy the rest of your day.